Stock markets take it on the chin. A bad day here all around for U.S. equities. Sharp declines in the S&P 500, sharp declines even in the tech-tilted Nasdaq, despite another batch of seemingly solid, not terrible by any stretch of the imagination, earnings from the Magnificent Seven companies. This time, results from Meta and Microsoft. But markets not liking it at all, and now face the crescendo in a busy week of economic data to cap things off. I'm Ilya Spivak, head of global macro here, and this is Macro Money. We're going to go all through it here, taking a look at what the markets did, which levels they find themselves at, and what they mean in the wake of this a brutal sell-off, and then consider what this incoming economic data, the U.S. jobs report for October, might do to shape next steps, and perhaps more than anything else, consider whether this even matters, whether we should care about this jobs data as we look to the onset of the U.S. presidential election in the early days of next week. And that's really where the conversation is going to begin. When we consider here that we have a very, very significant, let's call it, event risk in the immediate several sessions. Would the markets even consider laying out risk capital no matter what happens with economic data, no matter what happens with the broader story? Is anyone going to be motivated and have conviction to put on any kind of exposure this way or that before an event risk with so much built into it? So let's begin with a look at how the S&P 500 did today. Obviously, that is an ugly, ugly candle. The decline here looking like the worst one-day performance in almost 2 months. It doesn't get much better when you look at the Nasdaq. Here, also a violent sell-off, and that's not, again, withstanding the relatively supportive earnings numbers that we saw from Microsoft and Meta. This is the fourth, seemingly, in a series of letdowns. We didn't really get much follow through to the upside from solid Alphabet earnings earlier in the week, nor very impressive, as a matter of fact, Tesla earnings last week. So the Magnificent Seven, as they've become called, the big cap tech companies that account for the lion's share of strength in the U.S. stock market, their earnings seemingly not impressing the situation. Now, it's unclear in my mind why today was the day that the selling had to be catalyzed if we were to look at the raft of scheduled event risk, why this was in particular the day that the markets were going to get reactive. It could be that it's the last day of October, and so there's some end of the month squaring, especially as we look to that U.S. election in the first days of November. It could be the perking up of geopolitical tensions, another missile from Hezbollah striking Israel with casualty numbers starting to rack up, and Iran threatening maybe to get engaged again. So that could be, but this sell-off started before those headlines started to cross the wires and, for example, bid up crude oil. So it's not clear, other than a general crack in risk appetite, what sort of catalyst accounts for this kind of defensive posture. And what's perhaps more relevant to consider isn't so much why this happened when it's not plainly obvious by pointing to an economic calendar or an earnings calendar and saying, look, there it is what happens next given what is on the calendar and how markets in this fragile state might digest it. And this is where we turn to October's jobs report, where the expectation is we're going to get a meager 113,000 jobs added to non-farm payrolls. That's obviously a relatively small number. The last time we had anything comparable was April of this year at 108,000. You see that on your screen there. And so this would amount to essentially a retreat into the lower part of the 6-month range. So not offsides, not out there weakness, but certainly weaker than the recent range of outcomes. The unemployment rate seen holding at 4.1%. The wage growth reading, which isn't on the chart here, seen holding at 4%, as we just learned from the latest PCE numbers, which, as anticipated incidentally in our discussion yesterday, topped expectations a bit at the core, but nevertheless, the headline inflation rate they gave us was 2.1%. So wages at 4% are at this point growing at nearly double the rate of inflation, and extending a trend going back to April, May of 2023. So wages have now been topping the rate of inflation and essentially playing catch up with the cost of living issues that were created by that spike in inflation after COVID, and working it down for now over a year. So as 15 months, as a matter of fact, if the current numbers in the forecasts hold up. So with that in mind, we are looking at a report that, at least in relative terms, isn't perhaps worrying for growth, isn't worrying for consumption, as long as whatever weakness here is episodic and doesn't then extend more broadly. So as long as wages continue to grow by a widening margin relative to inflation, as long as they keep consumption thereby underpinned and keep improving the cost of living situation and affordability, then we probably don't have a risk to overall U.S. growth from data like this meager 113,000 rise in payrolls, unless that's the beginning of a trend, unless this extrapolates to further weakness. And it seems like that isn't what the markets envision here. There is some sense, perhaps, of resignation that there's going to be a weaker number here as perhaps a one-off, or at least as something of a shorter-term issue than a longer-term one, because, of course, the economy in the reference period for this data was battered by the two big hurricanes, Milton and Helene, and we likewise had strikes across the country, notably at Boeing, but also across hotels, for example, in California, in Hawaii. So you have a situation where you probably are primed somewhat in the markets for a weak result, and that need not spook anyone per se, unless the result actually beats meaningfully to the top side, in which case you face asymmetric risk that everybody is positioned perhaps for weakness, and that's what's priced in. But actually, if the result is higher, that's the bit that the market hasn't discounted to the same extent. So even a number lower than 113 might well be written off as well. These were the idiosyncratic factors that we were anticipating. They just had a little bit more of an effect than we thought, versus the number is meaningfully higher, and then the entire calculus needs to get turned over. There is some reason to suspect that you could be looking at this kind of a scenario. We look what's happened with U.S. economic performance since late August. We see that U.S. economic data has increasingly improved relative to expectations. Moreover, the momentum continues to build. So it isn't just that as of July, August, U.S. economic data was increasingly underperforming by a wide margin relative to baseline forecasts, suggesting, of course, at that time that maybe the Fed is too late to cut rates, which is why when it finally announced that it would start to do so in July, the response was negative from stock markets initially, because they looked at it and said, well, you're behind the ball at this point, because the economy had been deteriorating since mid-April, looking at the tenor of the news flow. But then in late July, not only did we get out of negative territory on this index, which would imply that the data tends to surprise down, and get back above zero into the territory where data tends to surprise up relative to forecasts, but the incline of this change, that's continued to steepen, meaning that reality continues to accelerate away from baseline expectation and give us a rosier picture of the U.S. economy, not only directionally, but momentum-wise, relative to what analysts' models are anticipating. So this 113 on non-farm payrolls might be a significant departure from just how strong job creation actually turns out to be. We got a little bit of a preview of that in the U.S. ADP employment report. It's, in fairness, not always the most representative, but it is worth looking. And what we find here is that we have a dramatic surprise higher relative to expectations, a rise in private sector payrolls of 233,000 against expectations of 115,000, which of course would be only 2,000 away from what is currently being expected for this official release. So what we end up with then is a situation where we have this sense that maybe the surprise to the top side starts to look comparable. And of course, if it does, then we have a situation where the markets have a big rethink that they will have to do. Get some similar inclinations from the latest PMI data, Purchasing Managers Index data from S&P Global. We haven't seen the ISM version of this data yet. Actually, the manufacturing sector will come out tomorrow after the jobs report, and service sector data is due next week. But what we get from the PMI version from S&P Global is an interesting sort of indicator. So it says that employment fell for a third month in October, but though the decline was only very modest and less than reported in August and September. On the one hand, that sounds ominous. Falling employment isn't good, but consider what this says. It's saying that employment fell for a third straight month, but of course, looking at the official data here, we know that in NFP terms, it did not. All these numbers are above zero here, going back to early 2020. So what we end up with is just the realization that the PMIs are different numbers. They're diffusion indexes. They're not absolute figures. So what this is telling us is that the pace of job creation cooled for the third consecutive month, but at the slowest rate in 3 months. In other words, October marked an improvement over the labor market as the PMIs shape their perspective around it in August and September. And if we look at what that would mean here, here's August, here's September, that would mean that the labor market, at least broadly in directional terms, improved. And if that were to give us something similar, or at least something meaningfully better than 113 on the headline number, if we can sort of thematically extrapolate that if the direction from the PMIs is for improvement in October versus August and September, well then a pullback to 113 is not where that is going. That, of course, raises the question of what it would mean for hot economic data to register in the context of Fed policy expectations. After all, not only do we have the election next week, but also a Fed policy announcement. And we can see that since the Fed issued its 50 basis point cut in mid-September, the story in markets has been one of increasingly hawkish reconsideration, where the markets have been cutting into Fed rate cut expectations, as we've seen, of course, this upshift in economic performance. So as the economy has become better, and that has fed inflation expectations, the markets have said, well, that means the Fed is going to be in a position to do less on stimulus, even after this initial 50 basis points was delivered. So if we look at where we are at this point, we are looking for a mere 110 basis points in cuts between now and the end of next year. That's a far cry from what the Fed's own forecast in mid-September would have implied. They said 200 basis points between the start of the cutting cycle and the end of next year, of which 50 is already in, leaving 150, two more cuts, November, that's next week, and December, and then 100 basis points in further cuts next year. Well, that's about 40 basis points lighter, what we see in the markets, than that Fed forecast. So as we consider then what comes next, note stocks have been pulling back as the latest round of hawkish speculation started to take shape here. So we find that this area established right in the wake of the Fed moving initially to cut rates is precisely where we've ended up again. So we tried higher, but then returned right back to this initial starting line, thanks almost certainly to some extent, and in my opinion to a significant extent, to this reshaping of policy expectations. And of course, if we get a hotter jobs number against this context, well, then this move may well have legs to continue. We already have markets fragile. We already have them looking at major event risk by way of this election, and we would be essentially adding higher borrowing costs as a kind of poison cherry on top. So that would, needless to say, run the risk, at least, that while markets could initially cheer a positive jobs number because more jobs is overall a good economic outcome, once the dust settles, the response from stock markets may be negative and may actually extend this decline ultimately as higher interest rates downstream are envisioned. Now, one more bit about the event risk. We can see here that the recent sogginess in stock markets has come along with a shifting of the betting odds in this election. And we can see that the direction of the shift has been closer in the direction of a 50-50 outcome, which is essentially where the polling numbers are. Now, regardless of what candidate is going to be this or that for policy, there can be ample arguments made on this side and on that side. And as traders, we're not interested in partisan politics. We're interested in making money. And so our perspective here is purely from that angle. And in seeing this move from a bigger gap to a smaller gap, very simply hints at greater uncertainty around the outcome. And if there's anything the markets hate, it is uncertainty. They can ultimately benchmark to this, they can benchmark to that, once they know what the result is. But if the result suddenly appears less certain, well, then there is increased volatility risk and an increased unease. If this continues to happen, stock markets face further concern. And the path of least resistance, at least recently, seems to be that way and probably is biased that way as the event itself grows closer, giving a bearish overhang to the stock's story more generally. Moreover, if there is a decisive victory for Vice President Harris, there's a strong possibility, looking at past experience, that former President Donald Trump is going to contest the results. At least that's what he did last time, which would extend uncertainty. So before we get into any sort of conversation about policy, any sort of conversation about what the markets will ultimately like from this grab bag of economic agenda items versus that one, before any of that enters into the fray whatsoever, or really any consideration about this candidate versus that is favorable for markets even has a chance to happen, the first conversation is about certainty of outcome. And as that certainty appears to slip a bit, obviously these are betting markets, this is not the gospel truth on what reality is, but if at least the perception is that the certainty around the outcome is starting to give way to a more clouded picture, then the markets are already dealing with a significant overhang for risk sentiment, and higher interest rates, if strong U.S. jobs data is what we end up seeing, they're not going to appear helpful. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back on with Chris tomorrow for Futures Power Hour. I'll be back again for First Call with Tom and Victor on Sundays. I'm writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. If you're watching this on YouTube, like and subscribe. Macro Money will be back next week. Happy trading.